Welcome back to this channel. This is Unfiltered Forex with me, Clement, and I am here to talk about yield curves. In the previous video, I'm sure you watched it. We started by talking about government securities, the bonds as they are commonly known, bonds, the types of government securities, their features, the face value, price and yield, inverse relationship. We talked about the discount bonds, premium bonds, the difference. We also saw the live chart of the US 10-year bond and the price and the chart of the yield. So in this video, we're going to talk about the yield curve, the definition, the types and shapes, why yield curves are important, what yield curves say about the economy, how they affect market prices, and everything you need to know when you all the info you need when applying yield curve info to day trading. So let's get into it. So here we are. Definition. A yield curve is a line. That's obvious. A yield curve is a line that plots the yields on bonds of different maturities. So the yield curve is a line. Usually it's an exponential growth curve. As you can see here, exponential growth. It's only natural to be paid more money for a longer term investment. That's why this is considered the usual shape of the yield curve. It's an exponential growth curve, as you can see, just going up like that. So this is the time. As you can see, this is the 1 month T bill. No, this is 1 month. Yeah, 1 month T bill, and this is the 30-year bond. So the 1 month usually has a shorter yield, a smaller yield compared to the 30-year bond, because yeah, if you're locking up your money for a long time, you of course expect a bigger return because if inflation, yeah, bonds are used to hedge against inflation, and also since it's a long time, a lot can happen in 30 years. So yeah, it's only natural to expect a higher yield on the longer term bonds and a lower yield on the short term ones, these monthly T bills. Yeah, you see, this is a yield, this is a time, this is a yield curve, this is how it looks. So for now, let me show you the website where you can see the live look of the yield curve. Here we are. This is the yield curve, and this is an inverted one. In a few, I'll explain why it looks like this. So this website is the U.S. Treasury yield curve, and it shows the yield curve for U.S. Treasuries, the bonds, the government security we were talking about in the previous video. U.S. yield curve. This is the yield curve of the U.S. currently. So as you can see here, there is a higher return on the short-term bonds. Let's use this pen. There is a higher return on these short-term bonds. Haha, this is monthly, 1 month, 2 month, 3 month, 4 months, 6 months. So you can see this these short-term bonds have a higher return, and these longer-term ones from 5 years to 30 years, they have a lower return. We're going to talk about this inversion in a few. It's not normal, of course. The normal yield curve is, in fact, let me show you what a normal yield curve looks like. We just have to go to a different date here and see. Just have to go to, okay, let's say September last year. No, not September 2 years ago. September of 2021. Yeah, 2021, September 15th. Yep, let's go. Yeah, here we are. So as you can see, 2 years ago, the yield curve was normal. The return on these short-term bonds was very low, close to zero. And then the return on these longer-term bonds was very high, the highest. So you can see it's an exponential growth curve. And that's how a yield curve is supposed to look like normally. This is the normal yield curve. But this is on September 2 years ago. This is how the yield curve was. It was normal, and yeah, in a few we're going to explain why it shifts. Moving on. Now let's talk about the yield curves, the shapes, stroke types of the yield curves. So number one is the normal yield curve, as I've shown you above. This it's an exponential growth curve. This is the normal one. This is usually what how it looks like for the most part. Number two, inverted yield curve. It's an exponential decay curve. As you have seen, the current curve is looking. It's an exponential decay curve. And the flat yield curve. Flat is just a horizontal line in general. So these are the three main types. There are no other types. These are the three main types of the yield curve, and we're going to talk about them. Let's start talking about the normal yield curve. Number one, normal. It's seen during a period of economic growth. So naturally, when the short-term interest rate, where is this highlighter? Yeah. Naturally, when the short-term interest rate is low, more investors would rather put most of their money to work into the economy and get a higher return in the short term than putting that money away for years to get the same yield, or putting it away for a short for the same amount of period of time, like for a few months, and get a yield that is close to zero in the normal yield curve scenarios you have seen. So this way the economy is stimulated. So yeah, the Federal Reserve, when they're talking about target range of the interest rates, they're usually talking about these short-term ones. So let's go back to that tab. So as you can see here, this mhm, here we tick this box to show the Fed funds target range. So and during this time, 2 years ago, the federal funds target range was zero, 0 to 25 basis points. This is where it was. So around this time, this is when this is when the, the Fed was keeping rates very low, keeping these short-term rates very low to stimulate the economy. So if if an investor, for example, has about $1 billion, instead of putting that $1 billion into these 6 months treasuries to get a return of 0.06%, it made more sense to put that money into the economy and get a return of about 5% because the economy was booming. So yeah, when these rates are low, when these short-term rates are low, the economy is being stimulated. Yeah, these short-term rates are the ones used to control monetary policy. So when they are low, the economy is doing good. Things are going great for the most part, usually. So now let's go back. Talk about the other one. Oh my goodness. Yeah, here we are. We talk about the normal yield curve. Now let's talk about the inverted yield curve. So, straightforward, a sign of economic weakness. If the yield curve is inverted, it means things are not going good. As of course, these yield curves follow the principle of high risk, high reward. If there's higher risk in the short term, you're going to get higher yield. So, putting this into this context, if 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 we're expecting the if the economy is okay, usually 30 years, if you are told to predict 30 years into the future, you are very likely to be wrong. Okay, that's obvious because a lot can happen in 30 years, so the risk is higher here. Let's use this pen again. The risk is higher in the longer term. That's why the reward is high. But if you're asked to predict what's going to happen in the next 4 to 6 months, you're very likely to be correct. So the risk is lower here because the future is foreseeable. That's why the yield is very low. So yeah, high risk, high reward. Now let's go back. So here we are. When when the short-term rates are higher than longer-term rates, this is Yeah, this is an inverted yield curve. When the short term future of the economy is uncertain, more investors would rather put most of their money in safe investments. These are bonds than invest in a risky environment. So if you remember, mhm. So if you remember when when we were talking about government securities, these are we said these are the considered the safest investments in the world. Yeah. So especially the US government securities, they are considered the safest investments in the world, and that's why they are very popular, and that's why we've been talking about them here. So when the short-term future of the economy is uncertain, more investors would rather put most of their money in safe investments than invest in a risky environment. This way, money is being drained out of the economy, and that's what's called tightening. That- Yeah, let's send this to back. So, yeah, this is what causes the tightening effect when a lot of money is being taken out of the economy and put into these short term bonds. Let's go back here and see. Now, this is the yield curve of 2 years ago. Now, let's go to the current yield curve. September. No, no, no. Current, we're in 2023, right? September, and I think it's 18. No, it's 8th, 9th. Yeah. So, this now is the current yield curve. You've seen how that shift has happened. Yeah, from 2 years ago and now. So, as you can see, first, this federal funds target range, it's at between 5.25 to 5.5 percentage points, and the 2 month yield is at 5.55%. The 1 month yield is at 5.52%. The 3 month 5.55, 4 month 5.6%, and 6 month is at 5.52. So what this means is, as we said, high risk, high reward. So if this is the highest at 5.6, it means in 4 months, people expect the economy to be doing very bad. That's why this one is highest. This one is the highest. This one has the highest reward because for the 4 month period, this is where the greatest risk is. And as you can see, the 1 year yield is not as high as these other ones, but it's still high. It's at 5.42, 5.42, 5.43 there. So yeah, as you can see, this is an inverted yield curve. This means there is a lot of trouble. The economy is in deep trouble because if it's more risky to predict the short-term outcome, that of course means the economy is very uncertain, and investors would rather put their money into these bonds than put their money into the economy. So there's that tightening effect. And as you can see, this target range, this highlighted blue area, it coincides with the short-term interest rate, the range. So yeah, this is what this these yield curves, these government securities are very important tools for maintaining monetary policy and yeah, just implementing monetary policy. So if the Fed says they're tightening, they raise these short-term target range, they raise these short-term rates, and then yeah, people now put more money into the bonds than into the economy. I hope you got that. So that was it for that one. Now let me go back to I'll go back here to the final one, flat yield curves. Yeah, the flat yield curve is just a pivot, the midpoint between when the curve is shifting from normal to inverted or vice versa. So yeah, let me look for an example when the yield curve was flat. Yes. This now is a flat yield curve. Okay, this general shape, this part, we you can just ignore it. You can just ignore that one, and we're going to focus on this other part from the 1 year to the 30 year. So you can see between the 1 year and the 30 year yield, it's pretty much flat. The yield at this time was not. So as you can see, this is flat because when the yield curve is inverting, this is how it usually goes. At some point, the yields for the monthly and the 6 months, these monthly yields, they usually they start picking up, but the yields for the 30 years they start falling. But yeah, so these ones they pick up, these ones are falling. So from this between this 1 year and 10 year, 30-year time frame, you can see it's mostly flat. The differential between the yields, the short-term ones and the long-term ones, is very small. So yeah, it's not even a full basis point. No, it's not even a full percentage point. It's just about 50 basis points, I think. Yeah. So as you can see here, the yield is very, the difference is very small, and this is the general idea of a flat yield curve. Well, it's very rare or almost never when you will see the yield curve being flat like this as a straight line. No, it usually has these oscillations, as you can see here. So when it's looking like this, it's called a flat yield curve. So in summary, what I'm going to do now is I'm going to show you all three shapes in this very one chart. So let me do that. So this is where we are now. These are the yield curves for September since 2021. This red line is for, yeah, you can see above here. Let's use this one. So this is the interest rate on September 14th, 2021. This is the interest rate on September 13th, 2022, and this is September 6th, 2023, the latest curve. So you can see on this September last year, it was an exponential growth curve. It was really it was good. The economy was healthy, and as you can see now, this currently is mhm, this is the flat one now for 2022. The blue line here, 2022. You can see it's mostly flat. The yield curve here was flat, and then currently 2023 September, the yield curve is inverted, meaning the short term rates are much higher than the longer term ones. So, as you can see, one common feature about these yield curve is when the yield curve is normal, all rates are low, even the longer term ones. All rates are low. You can see here they were all below 2% when the yield curve was normal. When the yield curve was flat, the rates are all higher than when the yield curve was normal. It's about, yeah, this is 2.5% up to around almost 4%. So here the yields are higher than when the yield curve is normal, but the difference is still very minimal. So this is the flat curve, and currently now this is where we are now. The yield, the interest rate, all of them, the percentage yield is very high, and yeah, the yield curve is inverted. The difference is here the short-term ones are much higher than the longer-term ones. So yeah, that's it about the shapes and the types of the yield curves. Yeah, these highlighted areas are showing the federal funds target range. Yeah, these highlighted faint areas. Yeah. So let me go to the next part now. Factors influencing yield curves. So factors influencing yield curves. This is these are the factors that make the yield curve look like the way you saw it look during, yeah. Expectation of future interest rates. This is number one and the top reason, usually the top factor. If investors expect interest rates to rise, they may demand higher yield for longer term bonds, leading to a normal or steep yield curve. Conversely, expectations of falling rates can lead to an inverted yield curve. So, when rates are low, it's expected that in future rates will be high. So, the longer term bonds usually have the higher yields when the yield curve is normal, leading to a normal yield curve. Conversely, when we're expecting interest rates to fall, the yield curve, the short term rates are going to be higher than the longer term rates because you're expecting interest rates to fall. So, this is what leads to an inverted yield curve. That is interest rate expectation, a very strong factor. Another one, economic conditions. So, economic indicators like inflation, GDP growth, and employment can impact yield curves. Strong economic growth and rising inflation can lead to steeper curves. So, yeah, when is high, the yield curve is going to be normal and very steep. So, let me use a pen here. So when the yield curve is high, no, when inflation is high, the yield curve is going to be normal and very steep because, if inflation is currently at 30 or 40%, I don't know. Okay, not that. If inflation is at 10% or 8%, in some countries it's very high. When inflation is that high and it's expected to go higher, that of course means you have to give investors a bigger return for holding money for a longer periods of time because of course to hedge against inflation. So yeah, that's how these strong numbers usually come to that's how these strong numbers usually come to affect yield curves. And yeah, usually strong economic growth leads to steeper curves. So the third one, central bank policy. Actions and statements by central banks such as the Fed in the US can significantly affect yield curves. Like you saw just in that chart. Central banks use monetary policy tools to influence short term rates, which can influence the yield curve, and that's called YCC. There's a monetary policy tool called, okay, um, I don't know how to call this. It's a style or something. It's called YCC. YCC is yield curve control. So central banks artificially control the yield curve to alter the direction of no to alter the monetary policy stance of the country. So if they want to tighten, in fact, let's go back to that curve and let me show you that. So here we are. We're just going to cancel out and this one, and now we're left with this one only. So in this, in this, let's just refresh the page, and we're going to see what goes on. So yeah, as you can see here, this highlighted blue region is showing the federal funds target range. So when the Federal Reserve, the central bank, raises the interest rates, they are raising the interest rates on these short-term bonds mostly because, yeah, if the short-term return is higher than the longer term, as you saw me talk about, yeah, the normal yield curve scenario, when the short-term bonds are paying higher than the longer-term ones, of course, more people would want to invest in these bonds and invest in the economy. So that's how the tightening happens. Market sentiment. Investor sentiment and risk appetite can also influence yield curves. In times of uncertainty or market stress, investors may seek the safety of longer term bonds, flattening or inverting the curve. So yeah, as you have seen, and as I have been explaining here, investors seek the safety of these bonds. Bonds are generally considered the safest investments in the world. So when there are times of uncertainty in the market, more investors will flock to government bonds and than opt to invest in the economy. So yeah, that's how the yield curve starts by flattening and then fully inverts when more money is being pumped into the bond markets because of yeah uncertain economic times. Moving on, now we're going to talk about the yield curve as a leading indicator. The yield curve is considered an economic leading indicator, a leading economic indicator. An inverted yield curve where short-term rates exceed long-term rates has historically preceded economic recessions in the United States. This is because it often reflects expectation of a future economic slowdown and lower interest rates. So yeah, if you watch the video where I talked about leading and lagging economic indicators, the link should be popping up somewhere. You did hear me mention that the yield curve is among the extremely leading economic indicators because when from the time a yield curve is first inverting, yeah, when the yield curve is first inverting, yeah, something like that. When the yield curve inverts, from the time when the yield curve fully inverts, when the short term rates become significantly higher than the longer term ones, there's a period of about 2 years or 2 or 1 year, depending on the strength of the economy, before the economy actually collapses. So, yeah, this is a extremely leading indicator, and yeah, that's how it works. So, the yield curve functions as a leading indicator because even now, when the economic downturn actually happens, the yield curve again is going to resume its normal shape. It's going to resume its normal shape, and that is another leading indicator to show that it's going to take at least 2 years for the economy to resume normalcy. Yeah, of course, this the difference between when the time the yield curve shifts, when the time the shape of the yield curve shifts, and the time of the economic downturn or the economic boom, what affects that speed is usually monetary policy decisions, how fast the central bank moves, or and yeah, how big the economy is. Because for a big economy, there of course will be lags in for these monetary policy effects to start showing up on the economy. So yeah, that's exactly how the yield curve functions as a leading indicator. When it's inverted, from the time when it first inverts, it's going to take like 1 or 2 years for the economy to decline. Like, okay, let's go back to that chart and see. Yeah, as I mentioned, and as I have been mentioning, when these short-term rates, let's bring this pen. When these rates are higher, these rates are telling you which period of which time frame is the economy most uncertain because it's a high risk, high reward scenario. So this kind of shows in 4 months the future of the economy is very much uncertain, and in 6 months the future of the economy is still very much uncertain but less than what we're expecting in the coming 4 months. So yeah, and even in the coming next year, you can see the rate is still very high. So investors are expecting that even the whole of this year and the whole of next year probably is going to be very tough economic wise. The economy is not going to do very good. So yeah, and as you can see, as we go as we continue with these time frames, you can see the yield drops significantly lower because people now are expecting in about 2 years things are likely to be okay. In about 3 years, things are likely to be good. And in about 7 years, we are likely to have completely escaped this, not escaped, we are completely to have. It's likely that the economy will have completely moved past this period of uncertainty. So yeah, that was it about that one. This is where we are now. How yield curves affect currency strength. Hmm. Interest rate differentials. Now this part is very relevant to day trading and forex trading in general. So interest rate differentials. One of the most direct ways yield curves influence currency strength is through interest rate differentials. When a country's central bank raises interest rates or is expected to do so, it tends to attract foreign capital seeking higher yields. This can increase demand for the country's currency, leading to currency appreciation. So, this is very direct, as you have seen in the example of the dollar. When yields are, when the short term yields are very high, that of course means even the home currency, the dollar in this case, is likely to also remain strong for that period of time. Another one is the yield curve shape. The shape of a country's yield curve can also affect currency strength. A normal steep a normal or steep yield curve where long-term rates are higher than short-term rates often signals expectations of economic growth and higher future interest rates. This can attract foreign investment and strengthen the domestic currency. So yeah, if people are expecting if the economy is doing good, of course the currency is going to be strong also because people are expecting the interest rates in the future to rise. So yeah, this if you watch the video where I talked about the pros and cons of fundamental analysis, we talked about delayed price adjustments, and yeah, that is very pronounced here in this point because if you're expecting interest rates to rise in a country in the next 1 or 2 years, of course there's going to be a lag of that 1 or 2 years before you see that change in the market or in the currency strength. So yeah, inversion and recession signals. Conversely, an inverted yield curve where short-term rates are higher than long-term rates can signal expectations of an economic slowdown or recession. This can lead to weakening of the domestic currency as investors seek safety in other assets or currencies. Yeah. Inversion and recession signal. We've talked about this, how the yield curve serves as a leading indicator of the economy. Risk appetite. The shape of the yield curve can influence investor risk appetite. A steep yield curve may encourage risk taking behavior, which can lead to a currency depreciation if investors move capital into riskier assets abroad. Conversely, a flat or inverted yield curve may lead to risk aversion and a stronger currency. Risk aversion and a stronger currency. Yeah. When the yield curve is fully inverted, the home currency will be strong in the short term. That's very direct. And when the yield curve is normal, the what do you call it? The home currency strength will remain weak for some time. Yeah, that was it about how yield curves affect currency strength. Next, we're going to talk about how yield curves affect the stock market performance. So here we are. Now we're going to talk about how yield curves affect stock market performance. So first, it's an inverse relationship. Now let's continue. Interest rate expectations. Yield curve changes can impact stock market prices by affecting interest rate expectations. A steepening yield curve may suggest expectations of economic growth, which can be positive for stocks as companies may see improved earnings. Conversely, an inverted yield curve may raise concerns about economic contraction, potentially leading to stock market declines. So yeah, when the yield curve is inverted, the stock market tends to not do good because an investor is comparing the percentage return they're likely to get from 1 month in the stock market and the percentage return being offered on the yields on the bonds for the time frame of between 1 to 6 months, it makes more sense to put more of your money into the government bonds and avoid the risky stock market. So yeah, interest rate expectation. If expecting the interest rates to go up and once the yield curve inverts, the stock market of course declines. Borrowing costs. The shape of the yield curve influences borrowing costs for companies. A steep yield curve typically means lower cost of borrowing for businesses, which can support corporate investments and stock prices. An inverted yield curve can lead to higher borrowing costs, potentially reducing corporate spending and affecting stock performance. So, yeah, during a time like now, when the short term yields are very high, banks are more likely to put most of their money into government bonds than lend that money out to companies. So, yeah, stock market is likely not to do good because of these high short term rates. When the yield curve is inverted, the stock market will not do good. Investor sentiment. Changes in the yield curve can impact investor sentiment and risk appetite. A steepening yield curve may boost investor confidence and risk tolerance, positively affecting stock markets. Conversely, an inverted yield curve can lead to risk aversion and reduced investor appetite for equities. So, yeah, all of this is generally almost the same point. When the yield curve is inverted, there is more money going into the bonds than into the stock market because yeah, the bonds are the considered the safest investments, and due to the very risky nature of the stock market, people or investors would rather invest in the bonds than invest in the stock market. So yeah, when yields are high, when the yield curve is inverted, when the yield curve is inverted and short-term yields are high, the stock market is likely to fall. And when the yield curve is normal and the economy is doing good, the stock market is likely to rise. So yeah, that's it about this. That's it about this video. I don't think I have anything else to add. I'm done.